On March 15, 2023, something happened that should have led every evening newscast in America, but it didn't. There were no emergency panels on cable TV, no front-page red banners. Most Americans went to work, scrolled their phones, and never realized that a cornerstone of their prosperity had just been quietly removed. On that day, Saudi Arabia, the world's largest oil exporter, confirmed it would accept Chinese yuan for oil sales to China, not just dollars. Yuan. For the first time in 49 years, the kingdom that sat at the heart of the global oil system agreed to sell the world its most strategic commodity in a currency other than the US dollar. In one move, the Petrodollar monopoly, forged in 1974 between Washington and Riyadh, stopped being a monopoly. Most people saw just another trade deal, but in the language of history, this was something else entirely. It was stage 6 in an 8-stage collapse pattern that has taken down every major reserve currency of the last 5 centuries. The Portuguese real in the 1600s, the Dutch guilder in the 1700s, the British pound in the 1900s, and now the US dollar is walking the same path, stage by stage, crisis by crisis. We are moving into the phase where alternatives gain critical mass, where network effects flip, and where collapse stops being theoretical and starts being exponential. Most people still believe this is impossible. They believe the dollar is too entrenched, too essential, too baked in to fail, that the system may wobble but can never truly break. The Portuguese thought the same in 1640. The Dutch thought the same in 1780. The British thought the same in 1940. They were all wrong. The dollar is now in stage 6 of 8. Alternatives are no longer ideas. They are functioning systems. The petrodollar is no longer unquestioned. It is cracking. BRICS nations are no longer spectators. They are building, and if you follow the timelines of previous reserve currencies, you arrive at a rough window. 10 to 15 years before the dollar loses its status as the undisputed reserve currency of the world, not destroyed. Not gone, but demoted from global referee to one player among several. When that happens, America's ability to print claims on the world as wealth and send the bill overseas ends. The $36 trillion of federal debt stops being a background statistic and becomes a mathematical trap. Interest rates spike, the inflation America has been exporting comes home. And living standards supported for decades by that invisible privilege fall by 30 to 40%. This is the economic story of our lifetimes, and yet almost no one is mapping it as a cycle. So in this film, we're going to look at the pattern, not the headlines, not the wishful thinking, the pattern, the 8-stage arc, that has ended 3 reserve currencies already. Where the dollar is located on that arc today, the mechanisms accelerating its decline, why the death of the petrodollar makes this transition faster than the ones before it, who stands to gain power from this shift, who stands to lose almost everything, and what the timeline looks like when you strip away politics and look only at history and math, because this isn't prophecy. It's pattern recognition, and the pattern is flashing red. Before we walk through the 8 stages, we need to answer a deceptively simple question. What is a reserve currency? Really? A reserve currency is the currency that governments and central banks around the world hold as their primary foreign exchange reserves. These reserves are the emergency oxygen of the global system. Countries use them to settle international trade, pay back foreign debts, defend their own currencies during crises. When one currency becomes the reserve, it gains for enormous advantages. First, structural demand. If almost every country needs dollars to trade, they must constantly buy dollars whether they like the United States or not. That creates a built-in, almost gravity-like demand for your currency, regardless of how strong your real economy is. Second, signeerage, the free lunch. If your currency is the world's reserve, you can print pieces of paper or, today, digital entries and exchange them for real goods and services from other nations. You create dollars. They ship you oil, cars, microchips, food. That gap between the cost of printing money and the value of what you receive is one of the most powerful hidden subsidies in world history. Third, cheap borrowing. Because everyone needs your currency, everyone also wants your government bonds. That means you get to borrow at lower interest rates than your fundamentals would justify. The market treats you as safer than you really are. This is why the US could run deficits decade after decade and still finance itself at relatively low rates, not because Washington was disciplined, but because the world had no alternative. Fourth, exported inflation. When you print more of your currency, the inflation doesn't stay at home. It spreads through the global system because foreign central banks and investors are holding your currency as part of their reserves. Your excess money creation becomes their problem. These 4 advantages make reserve currency status the ultimate economic weapon, but they also make losing that status catastrophic. Once the world no longer needs your currency to trade, demand for your money falls, your government can't borrow on the old generous terms. Printing money starts to translate into immediate domestic inflation because there's no one left to absorb it abroad. Your living standards, artificially boosted by decades of signeerage, fall back to what your real economy can actually support. That's what happened to Portugal, to the Netherlands, and to Britain, and it is what is beginning to happen to the United States. Now let's walk through the 8-stage pattern. This framework fits all 3 previous reserve currencies, and disturbingly, it fits the dollar almost perfectly. Stage 1. Dominance is born from real power. A currency doesn't become the reserve because of clever marketing. It becomes the reserve because the country behind it is unquestionably dominant economically, militarily, or both. That dominance creates trust. Trust that debts will be honored. Trust that trade routes will be protected. Trust that the currency is backed by real productive capacity. In the 1500s, Portugal controlled the spice trade, the internet of its day. Portuguese ships mastered the route around Africa to India and the East Indies. Spices, pepper, cinnamon, cloves were worth more than gold by weight. Through a combination of naval firepower and fortified ports, Goa, Malacca, Macau, Portugal turned the Indian Ocean into a near monopoly. If you wanted those spices, you needed to deal with the Portuguese, and that meant you needed reais, the Portuguese currency. It became, in effect, the reserve currency of Asian trade. In the 1600s, the torch passed to a new kind of power, the Dutch Republic. The Netherlands had the most efficient economy in Europe. Amsterdam became the beating heart of global trade. The Dutch East India Company VOC grew into the richest corporation in history, worth an estimated trillions in today's dollars. Dutch ships dominated trade in the Baltic, in Asia, and in the New World. But Dutch dominance wasn't just about ships. It was about finance. The Amsterdam Stock Exchange, founded in 1602, was the first modern stock market. The Bank of Amsterdam, founded in 1609, offered a stable, trusted unit of account. The guilder became the reserve currency because Dutch financial markets were the most liquid and trusted in the world. If you were a serious merchant, you held guilders. Then came Britain. After defeating Napoleon in 1815, Britain emerged as the undisputed global superpower. The Royal Navy owned the seas. British factories powered the Industrial Revolution. The British Empire controlled roughly a quarter of the world's land and population. The pound sterling became the reserve currency of a world stitched together by British trade routes. Under the gold standard, pounds were convertible into gold at fixed rates, making them as good as gold. By 1900, about 60% of global trade was invoiced in pounds. Finally, after World War II, the United States took the crown. In 1944, the Bretton Woods Agreement formalized what reality had already made clear. America held more than half of global GDP, most of the world's gold, and unmatched industrial capacity. The dollar was pegged to gold at $35 an ounce, and other currencies pegged to the dollar. The dollar effectively became gold. Even after Nixon ended gold convertibility in 1971, the dollar retained dominance through a new arrangement. The Petrodollar deal with Saudi Arabia in 1974. Oil, the real bloodstream of the modern economy, would be priced and sold in dollars if you wanted energy. You needed dollars, period. Stage 1. Dominance born from genuine strength, but built into that dominance is the seed of destruction. Stage 2. Peak power. And quiet overreach. At the height of power, something predictable happens. The dominant nation begins to overextend. It fights wars it can't afford. It maintains far-flung commitments. It borrows heavily, confident that the world will always finance its ambitions. It prints money to paper over political choices. For a while, the currency still looks strong. Network effects and habit mask the rot underneath. Portugal at its peak tried to project military power across dozens of ports, from Mozambique to Macau, but the country itself was tiny, roughly 1 million people. It simply didn't have the manpower or the tax base to sustain a globe-spanning empire. Wars with rival European powers drained the treasury. Portugal borrowed heavily from Italian and German bankers. By the 1560s, interest payments consumed the majority of royal income. The real still looked strong because of the spice monopoly, but the empire was already overstretched. The Dutch faced the same trap a century later. They fought 3 Anglo-Dutch wars between 1652 and 1674, plus repeated conflicts with France. Military spending soared. A trade and finance economy tried to act like a land empire and paid the price. The VOC was still profitable, but English rivals were rising. By 1700, the Dutch were spending more on defense than they earned from trade. Debt piled up. The guilder remained the reserve currency because Amsterdam's markets were still world-class, but beneath the surface, the foundation was cracking. Britain in the late 1800s looked invincible. By 1870, it controlled the largest empire in history, but by 1900, new rivals emerged. Germany industrialized at breakneck speed. The United States economy quietly surpassed Britain's. London continued to act as if nothing had changed. Britain fought the Boer War from 1899 to 1902 at enormous cost. It maintained the world's largest navy, even as tax revenues lagged. By 1914, Britain, the financial hegemon of the 19th century, had become a net debtor to America. The same pattern appears in the United States. In 1950, America's position looked unassailable, but the decades that followed were marked by costly wars: Vietnam, the Cold War arms race, the Gulf War, Iraq, Afghanistan, and by rising deficits. The Vietnam War contributed to the breakdown of the Bretton Woods gold link. In 1971, Nixon suspended dollar-gold convertibility because the U.S. could no longer credibly honor its promise. By 2008, U.S. federal debt had reached $10 trillion, yet the dollar remained the reserve currency, protected not by discipline, but by the lack of a credible alternative and the enforcement power of the petrodollar system. Stage 2 is always the same, an empire at its brightest on the map and its weakest in the balance sheet. On the surface, nothing has changed. Underneath, the pressure is building. The next phase is when the rest of the world quietly starts preparing for the day when the unthinkable becomes necessary. Stage 2 ends the same way. In every empire. On the outside, the roads still function, the armies still march, the currency still clears trades. Inside the system, though, the numbers stop adding up. Debts grow faster than income. Wars grow more expensive than victories. The privilege of issuing the world's money becomes a temptation that no government can resist. And the rest of the world notices. Stage 3, competitors quietly build escape hatches. Stage 3 doesn't begin with a declaration. It begins with a feeling in foreign ministries and central banks that the dominant power has started to abuse its position, that dependence on one currency, one financial system, and one capital city has become a risk, so they don't revolt, they hedge. Other powers begin to build alternatives, not to overthrow the reserve currency overnight, but to make sure they are never fully at its mercy. You can trace this phase across centuries. As Portugal overextended, other European powers watched the Portuguese model and thought, we want the trade, but not the dependence. Spain, England, and the Dutch Republic all built their own chartered companies, state-backed corporate machines aimed straight at Portugal's monopoly. The English East India Company, founded in 1600. The Dutch East India Company, founded just 2 years later. These were not small ventures. They had private armies, their own navies, and the backing of entire states. They offered better financing, more flexible contracts, and over time, more efficient logistics. By 1620, the Dutch controlled most of the spice trade that had once made Portugal unassailable. The real was still used in Portuguese zones, but for a growing share of global trade, the guilder and increasingly English financial instruments began to appear as credible alternatives. The same pattern unfolded a century later with the Dutch themselves. As Amsterdam's supremacy matured, London began to copy and then improve on Dutch inventions. The Bank of England, founded in 1694, provided a powerful anchor for British public debt. London's bond markets grew deeper. British trade volumes quietly overtook Dutch trade. By 1750, Britain's economy was larger, its navy more powerful, and its financial markets increasingly attractive. The guilder still carried the halo of habit, but the pound was rising as a rival waiting in the wings. Then came the Anglo-American transition. World War I shattered British finances. To fund the war, London borrowed heavily from New York. By the end of the conflict, Britain, once the world's creditor, had become a debtor to the United States. At the same time, America had built its own financial infrastructure. The Federal Reserve, founded in 1913, stabilized the dollar system. Wall Street emerged as a genuine competitor to the City of London. Again. No one flipped a switch. The pound remained the reserve currency. But the dollar was there, growing stronger, waiting for the moment when trust in sterling would crack. The 21st century replay looks similar, only faster. The 2008 financial crisis revealed deep fragilities at the core of the dollar system. Over-leveraged banks, moral hazard, and a Federal Reserve forced to unleash unprecedented quantitative easing just to stop the bleeding. For many countries, especially those outside the West, 2008 was a quiet alarm bell. If the center is this unstable, what happens when politics enters the picture? China, Russia, and others started building their own rails. China launched the CIPS cross-border interbank payment system in 2015 as a partial alternative to SWIFT. Russia develops its own financial messaging system. BRICS nations began openly discussing a common currency for trade and reserves. These systems weren't yet capable of replacing the dollar. But that wasn't the point. They were escape hatches, built in case the dollar system and the political power behind it ever turned hostile. Stage 3 is the just-in-case phase. No one wants to jump, but they're quietly checking where the exits are. Stage 4, currency becomes a weapon. And backfires. Stage 4 begins when the dominant power starts using its currency as a blunt instrument. In theory, this is rational. If your money controls the plumbing of global trade, you can punish enemies by turning off the tap. Sanctions, asset freezes, denial of access to payment systems. In practice, this is the moment when everyone watching realizes that the system they rely on is not neutral. It is a political weapon, and if it can be used against one country, it can be used against any country. The historical pattern is brutal. As Portugal weakened, it tried to compensate with force rather than competitiveness. Portuguese officials sought to keep control by excluding rival traders from their ports, seizing Dutch and English ships in Asian harbors. What happened? The rivals simply stopped relying on Portuguese ports. The Dutch built Batavia, modern-day Jakarta, as their own trading hub. England developed Fort St. George and Madras. By weaponizing access, Portugal pushed its rivals to build a parallel network. Once that network existed, Portugal's leverage evaporated. Britain repeated the mistake. During the Fourth Anglo-Dutch War, 1782-1784, Britain used its dominant navy to blockade Dutch ports. Dutch trade collapsed. The guilder lost value. Dutch merchants, unable to operate normally, began to route more business through London and British banks. Britain's attempt to crush a competitor ended up absorbing that competitor as financial business and set the stage for London to replace Amsterdam as Europe's financial capital. Later, during World War I, Britain weaponized finance again under the Trading with the Enemy Act of 1914, freezing German assets in London. It was effective in the short term, but it also sent a chilling message. In wartime, your money in London is not really yours. After the war, neutral countries quietly reduced their sterling holdings, wary that Britain might one day use the same tools on them. When the Great Depression forced Britain off the gold standard in 1931 and devalued the pound, much of the remaining trust evaporated. Reserves diversified toward dollars and gold. Weaponization had delivered a tactical victory and a strategic wound. In the American case, Stage 4 has been even more dramatic because the tools are more powerful. The first major episode came in 2014 after Russia's annexation of Crimea. The United States and its allies imposed sanctions that limited Russian access to certain dollar-based transactions. The message in Moscow was clear. If we stay in this system, Washington can choke us at will. Russia responded predictably. It cut its dollar reserves from around $130 billion in 2013 to near zero by 2020. It doubled its gold reserves. It accelerated development of SPFs and deepened financial ties with China. But the real turning point came in 2022 after Russia's full-scale invasion of Ukraine. In an unprecedented move, the U.S. and its allies froze around $300 billion of Russian central bank reserves and pushed to cut Russian banks off from SWIFT. From Washington's perspective, this was the nuclear option in financial warfare. From the rest of the world's perspective, it was something else, a terrifying revelation. They saw that central bank reserves, the supposedly sacrosanct savings of nations, could be switched off with a keystroke if you ended up on the wrong side of Western policy. If that could happen to a G20 country with nuclear weapons, what about everyone else? The result was a quiet but immense psychological shift. China began steadily reducing its holdings of U.S. treasuries from peaks around $1.3 trillion down to well under $1 trillion. Saudi Arabia and other Gulf states started diversifying reserves, increasing gold and non-dollar holdings. Central banks globally bought more gold in 2022 to 2024 than at any time since the 1970s. At the same time, the drive to build parallel payment systems intensified. CIPS volumes grew, bilateral trade deals in local currencies multiplied, BRICS expansion and talk of a commodity or gold-linked currency became louder, less theoretical, more urgent. The very act of using the dollar as a weapon accelerated the search for ways to live without it. This is the essence of Stage 4. Weaponization that was meant to strengthen the dominant currency's grip instead convinces the world that staying fully inside that system is existentially dangerous. From that point on, the shift away from the reserve currency is no longer a distant academic idea. It becomes an active risk management strategy, and that leads directly to Stage 5. The moment when confidence doesn't just wobble in private memos, but starts to show up in the numbers. Stage 4 ends with a psychological earthquake. The world sees what the dominant power can do with its currency, and for the first time, they imagine a future where they must protect themselves from that currency. Stage 5 is where that imagination turns into action. This is the moment when confidence cracks, not as a theory, not as a worry, but as measurable shifts in how countries hold their reserves and settle their trade. And once this begins, history shows that the decline is not reversible. It may be slow, it may be disguised behind political optimism, but the curve never bends back up. Stage 5. The silent decline. Confidence breaks and reserve share falls. Every reserve currency reaches a point where its supremacy no longer reflects underlying strength, only habit, and habits can change. For Portugal, the cracks appeared when merchants realized the real was no longer the most useful currency for business. As Dutch and English trading networks grew, the real gradually faded from being the lubricant of Asian trade. By 1640, the real had fallen from controlling roughly 60% of Asian trade currency flows to less than 20%. It didn't happen overnight, it took decades, but once the decline began, it never reversed. The Dutch guilder faced a similar fate after the crippling British blockades of the late 1700s. And multiple wars with France, Dutch trade volumes fell. The financial dominance that Amsterdam had enjoyed for a century began to erode. Merchants and central banks reduced their guilder holdings, shifting toward British financial markets. By 1815, after the Napoleonic Wars, the guilder was no longer the world's reserve. Its share fell from roughly 40% to near irrelevance. In about 35 years, the British pound repeated the script in the modern era. After World War I, Britain was drowning in debt to the United States. The pound lost credibility each time Britain devalued or suspended gold convertibility. Countries diversified slowly but steadily toward the dollar. By 1940, sterling's reserve share had fallen from 60% to around 30%. And by the end of World War II, the dollar had effectively taken the throne. Each decline took decades. Each followed the same steps. Each began quietly with a shift in preferences long before a shift in headlines. The US dollar Stage 5 looks almost identical. Dollar reserve share peaked at 71% in 1999. By 2024, it had fallen to 58%. Not a collapse yet, but steady, relentless, accelerating. The drop from 2022 to 2024 4 full percentage points is one of the sharpest two-year declines in modern reserve currency history. The metrics on global trade invoicing are even more startling. In 2022, roughly 73% of global trade was billed in dollars. By 2024, that share had dropped to 58%, a 15 percentage point decline in 2 years. This is the numerical fingerprint of Stage 5, confidence. Has cracked. Alternatives have begun to feel safer, more neutral, more aligned with a shifting world. The decline won't reverse. Why? Because Stage 6 is already forming in the background, the point where alternatives reach critical mass and network effects, once the dollar's greatest advantage, begin to flip against it. Stage 6, network effects flip the rise of functional alternatives. Every reserve currency benefits from a simple truth. People use it because other people use it. This network effect is what made the pound dominant even as Britain's power faded, and what kept the dollar at the top long after American manufacturing began to hollow out. But network effects cut both ways. The same mechanism that props up a currency can also accelerate its fall once usage begins to shift. Historically, when Dutch and English trading systems became more efficient than Portugal's, merchants naturally switched to the guilder. When London's financial markets became deeper than Amsterdam's, merchants switched to the pound. When American credit markets dwarfed British ones after World War II, the world switched to the dollar. These transitions didn't require political declarations. They were driven by convenience, and convenience is the strongest force in global finance. Today, for the first time in 50 years, the convenience curve is bending away from the dollar. March 2023 was the symbolic turning point. Saudi Arabia's acceptance of yuan for oil wasn't merely a diplomatic gesture. It was a functional shift in global energy trade, the center of gravity of the entire dollar system. And it triggered a domino effect. By late 2024. Saudi Arabia formally joined BRICS, ending the era of automatic alignment with U.S. financial objectives. China's CIPS payment system processed $27 trillion in transactions, more than doubling its usage in just 3 years. India and Russia settled billions in trade using rupees and rubles. Brazil and Argentina negotiated trade protocols bypassing the dollar entirely. The way accepted yuan for oil shipments to China. None of these steps alone dethrones the dollar. But taken together, they show something unprecedented. The alternatives are now good enough to use, good enough to scale, good enough to hedge against us financial power. That's the meaning of Stage 6. When the alternatives are functional, behavior changes. When behavior changes, the network effect flips. And when the network effect flips, the dominant currency loses not gradually but exponentially. We are watching that flip happen in real time. The global share of trade invoiced in dollars collapsing from 73% to 58% in 2 years is the beginning of the spiral. Once merchants begin choosing non-dollar currencies because their partners accept them, the old logic of everyone uses dollars, so I should too evaporates. Portugal watched the same spiral. The Netherlands watched it. Britain watched it. And now the United States is watching it. But Stage 6 is not collapse. Not yet. Stage 6 is the tipping point, the moment when the world becomes ready for a crisis to accelerate the transition. And history shows that Stage 7 always arrives sooner than the dominant power expects. A glimpse of what comes next. Stage 6 is the moment before the storm. The numbers still look stable enough, markets still function. The dominant currency still clears most global trades. But underneath, the system is brittle, one shock away from moving into the most violent phase of the cycle. In every previous reserve currency collapse, the transition remained slow until it wasn't, and the trigger every time was a crisis, war, financial panic, debt implosion, a geopolitical humiliation when that crisis hits. Diversification becomes panic, hedging becomes flight. Reserve management becomes survival. This is the doorway to Stage 7, the part of the pattern where everything accelerates at once. Stage 6 is the tipping point, the moment when the world quietly prepares for something irreversible. Stage 7 is when that something finally arrives. If Stage 5 is the silent erosion, and Stage 6 is the moment the ground softens beneath the dominant currency's feet, then Stage 7 is the earthquake, sudden, violent, transformative. It is the moment in every reserve currency cycle when theory becomes reality. And reality becomes crisis. Stage 7, crisis acceleration, when the system breaks open. In Stage 7, the shift away from the reserve currency stops being strategic or diplomatic. It becomes survival. Governments no longer diversify gently. They dump. Central banks no longer reduce exposure. They run. A trigger event, often unpredictable in specifics but inevitable in form, causes global confidence in the dominant currency to collapse with frightening speed. Every previous reserve currency collapse followed this script. Portugal's breaking point, the War of Spanish Succession, 1701–1714, destroyed what remained of Portugal's fragile trade supremacy. France blockaded Portuguese ports. The empire's Asian trade collapsed. The real, once central to Indian Ocean commerce, became little more than a domestic token. By 1720, the currency was worthless outside Portuguese borders. The Dutch breaking point, the Napoleonic era, delivered the death blow to the guilder. Amsterdam, occupied by French forces, was cut off from its colonies and trade routes. Dutch finance, once the safest in the world, dried up overnight. After Napoleon's defeat, Amsterdam never regained its status. London had already become the new global financial center. The guilder didn't fade, it fell. Britain's breaking point, World War II, was the crisis Britain could not survive financially. The war bankrupted the empire. Britain owed the United States more than 3 times its GDP. By 1949, the pound was devalued by 30%. By 1956, during the Suez Crisis, Britain learned a humiliating truth. The United States could collapse the pound at will if Britain disobeyed Washington. That was the moment global markets understood the pound was no longer the world's anchor, from dominant currency to subordinate in 15 years. What will trigger America's? Stage 7. History doesn't repeat itself exactly, but the pattern does. Here are the 4 most likely triggers for the dollar's crisis acceleration. 1. A BRICS currency launch. If BRICS releases a gold-backed or commodity-backed trade currency around 2026 to 2027, it gives the world something it never had before, a credible, neutral alternative to the dollar for global trade. If major oil exporters begin accepting it, dollar demand collapses instantly. This single development could push the dollar from stage 6 into stage 7 in months, not years. 2. A U.S. debt spiral. America's debt is now $36 trillion, and interest payments have passed $1.2 trillion per year, the largest line item in the federal budget. If investors lose confidence and demand higher yields, the Federal Reserve will face an impossible choice. Print money to suppress rates, inflation explosion, let rates rise, government insolvency, either outcome breaks confidence in the dollar. 3. Military overextension. If the U.S. becomes trapped in simultaneous conflicts, Taiwan, Ukraine, Middle East, without clear victories, the world will begin questioning America's capacity to police the global financial system. Reserve currencies do not survive perceptions of declining power. 4. A banking crisis triggered by commercial real estate. Between 500 and 1,000 U.S. regional banks are exposed to collapsing commercial real estate valuations. A wave of failures could spark a broader financial panic, forcing the Fed to flood the system with liquidity. In a stage 6 environment, that much money printing would be interpreted globally as a sign of terminal weakness, not strength. What happens when stage 7 ignites? When the trigger hits, diversification turns into a stampede, countries dump U.S. treasuries, the dollar falls 30-50, U.S. imports become catastrophically expensive, inflation surges, the Fed is forced into emergency rate decisions. Recession or depression becomes unavoidable. There is no good option during stage 7. If the Fed prints to stabilize the bond market, inflation. If the Fed raises rates to defend the dollar, mass bankruptcies. Every path leads to severe contraction because the dollar's privilege of exporting inflation would be gone. This is the moment when the United States finally experiences the cost of losing reserve currency status. But stage 7 isn't the end, because after every collapse, Portugal's, the Netherlands', Britain's, a new system emerges, and that leads us into the final transformation. Stage 8, replacement. A new monetary order takes shape. Stage 8 is not overnight, it is not chaos forever. It is the period when a new reserve system slowly consolidates power while the old one shrinks into a regional role. Portugal faded into domestic irrelevance. The Netherlands faded into a secondary financial player. Britain retained influence but no longer dominance. The US dollar will follow the same path. It will still exist. It will still be important. But it will no longer be the center of world trade and finance. What could replace it? Option 1. The Chinese yuan. China has the scale, the trade networks, and the infrastructure. But capital controls and political opacity limit the yuan's global trust. Possible but not inevitable. Option 2. A multipolar system. This is increasingly likely. A world where USD holds 35.40, Euro holds 20.25. Yuan holds 20.25, BRICS currency, gold-backed assets hold 15.20, no single currency dominates. Trade becomes decentralized. Financial power becomes fragmented. Economic influence becomes regional instead of global. Option 3. A gold or commodity-backed BRICS currency. If BRICS creates a reserve asset backed by real commodities, oil, metals, agricultural output, or gold, it could become the world's preferred neutral currency. This is the most profound threat to dollar supremacy, because trust in a commodity-backed currency is structural, not political. Why the petrodollar's collapse will be faster than all previous transitions. Every previous reserve currency transition, real, guilder, pound, dollar, took 30 to 50 years. The dollars will be faster. Why? 1. Technology compresses time. In 1910, moving gold across oceans took weeks. Today, moving $100 billion takes seconds. Reserve shifts that once required fleets can now happen with a keystroke. 2. Multiple alternatives already exist. Past transitions had only one replacement. Today, yuan, euro, BRICS currency, CIPS, gold, crypto, rails, the world doesn't have to wait for alternatives. They already work. 3. The petrodollar was always artificial. The dollar's dominance since 1974 wasn't pure economic strength. It was geopolitical architecture held together by a single bilateral agreement with Saudi Arabia. And that agreement is dead. Once oil can be bought in yuan, rupees, euros, or gold-backed instruments, the dollar loses its most important anchor. 4. US debt is historically unprecedented. Portugal didn't have $36 trillion in debt. Neither did the Dutch. Neither did Britain. No previous reserve currency tried to sustain this level of leverage at the moment of decline. 5. Globalization means faster contagion. Today's world is more interconnected than any in history. $80 trillion in dollar-denominated global debt, $13 trillion in U.S. treasuries held by foreigners, $21 trillion U.S. money supply. A shift in confidence reverberates instantly across every financial system. This is why the U.S. transition will not mimic the slow decline of the pound. It will be faster, sharper, more volatile. And now, the timeline based on historical patterns and present acceleration: 2002-2008, peak dominance stage 2, 2008-2014, competitors build alternatives stage 3, 2014-2022, dollar weaponization begins stage 4, 2022-2023, confidence cracks transition to stage 5, 2023-2025, alternatives gain mass. Trade shifts accelerate stage 6, 2025-2030, BRICS currency launch. Network effects flip fully late stage 6, 2032-2035. A crisis triggers panic diversification stage 7, 2035-2050. New reserve system emerges stage 8. Could this be slower? Yes. Could this be faster? Absolutely, especially if a major crisis arrives early. The direction, however, is fixed: who wins and who loses. This transition will create the largest wealth transfer in modern history. Winners, gold holders, BRICS nations, commodity exporters, countries with low debt neutral financial hubs. Losers, U.S. consumers, dollar savers, treasury bond holders, countries with large dollar-denominated debt. Wall Street and U.S. global financial firms. The U.S. federal government loss of cheap borrowing. The U.S. loses the most because its living standards have depended on a privilege no other modern nation enjoyed: the ability to print the world's money. When that ends, America faces the same adjustment Britain faced from 1940 to 1970, a long decline in geopolitical reach and domestic prosperity. The pattern is complete: the real collapsed, the guilder collapsed, the pound collapsed, not all at once. But inevitably, the dollar is in stage 6, entering stage 7, and nothing in the historical record suggests that any reserve currency has ever reversed course at this point. What lies ahead is not the end of America, but the end of its 50-year free lunch, and the beginning of a world where the dollar must live by the same rules as everyone else. The cycle is ending. Another will begin. But cycles never rewind. We've traced the dollarist journey through 6 of the 8 stages of the reserve currency cycle: its rise, its dominance, its overreach, the emergence of competitors, the weaponization, miscalculation, and the quiet but accelerating shift toward alternatives. Now we arrive at the philosophical heart of this story, the part most people overlook, yet the part that history never fails to teach. Reserve currencies do not die from weakness alone. They die when the world stops believing the story behind them. A currency is not just paper or digital entries or lines of code. A currency is trust crystallized into form. The moment that trust begins to fracture, not just in the markets, but in the collective psychology of nations, the countdown begins. The United States is entering that countdown, not because the dollar is worthless, not because America is collapsing, but because the cycle itself is unavoidable. Every reserve currency in history follows the same arc, because every empire, no matter how exceptional it believes itself to be, eventually succumbs to the pressures of time. Economic competitors rise, military commitments outgrow resources, politics turns inward, debt accumulates, privilege breeds complacency, and the world gradually adapts to a future where the old guardian no longer holds the keys. This is not decline in the Hollywood sense, dramatic, explosive, overnight. It is decline in the historical sense, structural, systemic, the slow erosion of a privilege the world no longer needs and will no longer tolerate, the end of the petrodollar and the end of an era. When Saudi Arabia accepted yuan for oil in March 2023, something fundamental shifted beneath the global economy. For nearly 50 years, the petrodollar had been the invisible architecture of American power. It ensured constant demand for dollars. It ensured deep liquidity in U.S. debt markets. It ensured that America could consume more than it produced and print more than it earned without suffering the consequences that every other nation must endure. That architecture is now dissolving. One soil can be bought in multiple currencies. The dollar is no longer the central artery of global trade. It becomes one currency. Among many, a strong currency, yes. A vital currency, yes. But not the sun at the center of the financial solar system. The shift is subtle now, but in hindsight it will look like a rupture the moment the logic of the 20th century gave way to the logic of the 21st. And in that new logic, no single nation can control the flow of money the way America once did. What the post-dollar world actually looks like. Popular imagination envisions two extremes. Either the dollar collapses into irrelevance or the yuan becomes the new global master. Reality will be more complex, more nuanced, and far more interesting. The likely outcome is a multipolar currency world, where influence is fragmented rather than centralized. Dollar, 35 minus 40 euro. 20 yuan, 20 minus 25 BRICS gold-backed instruments, 15 minus 20. No single currency becomes the new pound, the new guilder, or the new dollar. Instead, the world transitions into a network of overlapping spheres, a system where power is distributed, trade routes are diversified, and dependency on any one nation becomes strategically unacceptable. This is not collapse. This is decentralization. A world where oil may be priced in yuan in Asia. Commodities may be priced in gold-linked instruments. European trade relies more on the Euro. Africa, Latin America, and the Middle East hedge between blocs, and the United States, for the first time since World War II, must operate without the privilege of printing the world's reserve asset. This is the true end of the free lunch. What? It means for the United States. For 50 years, America has effectively lived in two economies. 1. The real economy, manufacturing, technology, services, agriculture. 2. The privilege economy, the invisible subsidy created by the dollar's reserve status. The real economy is strong but not exceptional. It produces innovative companies, but it also imports most. Consumer goods. It generates wealth, but not enough to cover the monumental gap between spending and revenue. The privilege economy, however, created an illusion of abundance. It allowed deficits without pain, consumption without sacrifice, and borrowing without consequence. When that privilege fades, America will still be powerful but on more equal terms with the rest of the world. Living standards will adjust downward by 20-40 over a decade. Imports will become more expensive. Foreign capital will be less willing to fund U.S. deficits. Interest rates will reflect actual risk rather than global dependence. Fiscal choices will carry real consequences as they do for every other nation. It will not be an apocalypse, but it will be an awakening. An awakening to the reality that prosperity must be earned, not leveraged through global privilege. An awakening to the fact that America's future strength will come not from financial dominance, but from the resilience of its society, the creativity of its people, and the adaptability of its institutions. The dollar will survive. But the era of dollar supremacy will not. Those two truths are not the same. If you understand the pattern, you understand the future. The story we've just traced from Portugal to the Netherlands, from Britain to the United States, is not a story of disaster. It is a story of evolution. No reserve currency remains forever because no empire remains forever. Technology changes. Trade routes shift, demographics evolve. Geopolitics rewrites itself, and money, the purest expression of trust, follows the world, not the other way around. The dollar's decline is not a tragedy. It is a transition into a world where power is more distributed, where no single country can freeze another nation's economy with a keystroke, and where global finance becomes more competitive, more decentralized, and ultimately more stable. But transitions are rarely smooth. The coming decade will be filled with volatility in markets, in geopolitics, in domestic politics. Old assumptions will die. New alliances will form. Entire industries will reshuffle themselves around new financial centers. And through it all, the 8-stage pattern will continue its quiet rhythm. Rise, dominance, overreach, competition, weaponization, alternatives mature. Crisis accelerates, replacement begins. The United States now sits between stage 6 and stage 7. The window is narrowing, the pace is quickening, and the world is preparing consciously or unconsciously for the moment when the cycle turns. A final note to the viewer: if this documentary opened your eyes to the deeper mechanics behind reserve currencies, if it revealed the pattern that has repeated itself for 5 centuries, if you can now see why 2023 was a historic turning point, then the next decade will make far more sense to you than to those who believe the present system is permanent, because history doesn't repeat, but it rhymes consistently, mercilessly, beautifully. Right now, the rhyme is unmistakable. Portugal, 1640, the Netherlands, 1800. Britain, 1945, the United States, 2025 to 2035, different nations, different eras, same cycle. The dollar is not dying tomorrow, but its era of supremacy is ending inevitably, structurally, and irreversibly. If you want to track each step of this transition, each BRICS development, each milestone in de-dollarization, each signal that stage 7 is approaching, then stay connected. Because the next 10 to 15 years will reshape the global financial map more dramatically than any period since World War II. The petrodollar is dying, the cycle is turning, and a new monetary world is being born.